Another increase in rates, another sharp sell-off in equities, some big options trades and fixed income ETFs we'll discuss tonight on Open Interest. Hello everybody. 2s rose 29 basis points to 3.35%. 10s rose 20 basis points to just under 3.36%. The increase in rates and flattening of the curve in response to more abysmal inflation and consumer confidence data last week, prompting another sharp sell-off in equities. The S&P fell almost 3.9% and the NASDAQ 100 fell 4.6%. For many months, we've been discussing rising rates on Open Interest. Before we talk about today's activity, let's have a quick look back first to what Carter Worth said on this channel back on February 10th.
You know, it's remarkable. Sometimes levels are very unclear and sometimes they're discernible and clear. So this is an all data chart for 10-year yields going back to the Volcker era, where the peak, of course, and that downtrend line. Now, this is an arithmetic scale. Take a look at the log scale on the next chart. Fascinating. It's touched that line to the penny. Now, if we go back and forth, arithmetic log, it would suggest on the arithmetic scale that we're basically where it should stop, 2.15. But if you look at the log scale, the implications are that we can get as high as 275. Now, were we to get to 275, I think it's probably lights out for the stock market.
So indeed, rates did hit and ultimately exceed 2.75%, as Carter suggested, and equities fell sharply. Then, in late April, as rates approached 3% after LQD saw some steep declines and further bearish put activity, I had this to say. The picture here still remains pretty grim. LQD options volume was actually unexceptional today, but there's two things that you ought to know about LQD when you take a look at it. The first is it's high duration. What that means is that the constituents, there's a lot of long-dated paper in there. And the longer duration suggests that, well, it doesn't suggest, it means you have greater sensitivity to changes in interest rates. If you have a long duration portfolio, that price is going to drop more when interest rates rise than if you have a shorter duration portfolio. So in general, there's two things you want to think about. Do you think 10s and 30s are capped at 3%? Then maybe you happen to also believe that most of the damage in here is done. I suspect rates pause here as folks digest the equity sell-off and the recession fears, but ultimately I think they're going to resume an upward trend. So obviously they did resume a higher trend, and let's take a look at what happened in LQD, the investment grade corporate bond ETF today. We saw another large put spread purchase. This time it was the October 95-85 put spread. Ultimately, all day, over 138,000 contracts traded, and that included 134,000 of institutional blocks of 72 and 62,000 contracts, respectively. A couple things about that. First of all, 138,000 contracts represents 13.8 million shares, or nearly $1.5 billion worth of LQD at current prices notionally. Secondly, the 95 strike is roughly 11% lower than LQD's closing price today, and the 85 strike is over 20% lower. This spread is targeting a move lower potentially, or at least as big or bigger than the one we've already seen since the highs that LQD hit last August, when it hit its all-time high. And rates have risen about 2.18%, 10-year rates have risen about 2.18% since then. So is the buyer of this put spread anticipating that rates could rise to 5.5% by October? It's possible. It's also possible that the trader believes spreads could widen. And we actually have seen some of that as well. And it's also possible that the trader believes that the flattening yield curve and consumer sentiment data suggests a recession is imminent. And a recession could impact corporate profitability. Roughly half of the bonds held by LQD, as I've previously mentioned, are among the lowest credit ratings to be considered investment grade. We're talking BBB, BBB minus. A credit rating downgrade to those issuers might make some of those holdings ineligible, creating even more selling pressure. Now, the Wall Street Journal reported today that the Fed might get more aggressive and raise 75 basis points at the next two meetings. And I would guess they've probably spoken to someone at the Fed before they would print that. And the reason is that Jerome Powell has been trying to match his words to action, or maybe inaction is more appropriate if you feel, as I do, that policymakers, both fiscal and monetary, have been derelict, despite constant warnings from the financial services community about asset bubbles and inflation risk. Will LQD trade down to 85 by October? I hope not, because if it does, equity investors' pain is far from over. But consider this. That trade pays 19 to 1 if it does trade down 20%. And that's an attractive enough payout for at least one institutional trader to commit about $3 million in premium to make that bet. In any event, even touching bear market territory again today, and even though it's been historically a good entry point for stocks, when it does do that, I believe there's further downside here. Policymakers can't print their way out of this problem the way they did earlier ones. And in fact, money printing is itself the problem. If money printing propelled stocks up, reducing the money supply, which is the only appropriate course of action here, will hit them and make them go further down. Nobody wants a bear market or a recession, but that's still better than a recession combined with inflation. So please like, comment, and subscribe, and I'll see you in the next one. And in the meantime, you may want to consider reading The Anxious Investor. Our friend Scott Nations recently put this book out, and it seems relevant.